Welcome to Key Stock and Crypto channel. Don't forget to like and subscribe to the channel.
And guys, we had stocks and cryptos up today. And remember, guys, we are in the most manipulated market in history. Because the only thing we had to do was look at yields and look at the dollar to see why we were up. And don't forget, guys, GDP comes out on Thursday. And we will see how they play it in the media. But we have Jim Cramer says the U.S. dollar decline helped drive the market today. And he is exactly right, along with yield rates being pushed down. And we know that strong dollar is crushing the emerging markets. But we know why the reason they're doing this. And that's to get the fourth industrial revolution built. Remember, they printed 20% of all money in existence in 1 year. Now, we had big tech earnings today, and it's going to be for the rest of the week. We had Alphabet misses earnings, and they say that ad revenue is down. The crypto winner, which we know a lot of those ads were frauds. But guys, they still had a $7 billion revenue. And we know these corporations want to keep improving quarter after quarter after quarter. But their ad revenue was $7 billion, and they're talking about making cuts. Unbelievable. And we had Microsoft drops off a weaker guidance. But all these corporations are putting out a weaker guidance because we know 2023 and 24, the Fed is going to keep rates still high and then plus start shrinking these balance sheets. And it's not just the Fed. It's majority of the big central banks. They're moving in lockstep, and that's what's crushing the global economy. And I went over that China's GDP rose 3.9%, and a lot of their cities were on lockdown. I'm not your financial advisor, not financial advice. Please do your own research. But just imagine when these economies open up in the emerging markets, the type of growth that they're going to see. It's going to be unbelievable. And remember what BlackRock stated. The United States is going to go 10 years with no growth. And we're starting to see how that's going to happen. And we know Google and Microsoft is invested in the emerging markets. And we always follow the money. Now we have EV startup Faraday slashes salaries. And we know these smaller EV companies are either going to be bought out, merge, a lot of consolidation, or go out of business. Now we have Amazon will now let users pay with Venmo at checkout. And we see all these big corporations are creating a digital wallet. So we know the next step is going to start paying with digital currencies. First, we know stable coins, the same as they're using with fiat, is this digital fiat. And then we know they're not going to bring it to the people until it's seamless, where the people won't even know they're even using digital currencies. Now, guys, we're going to go over the actual indicators. We had yield rates, like I stated today, decline. And of course, this article states that the Fed may pivot or slow up rates. And guys, we know that's not going to happen. The reason why? Because they want to get rid of the current industrial revolution that we're in right now, which is the third, and bring us forward into the fourth, where automation becomes an everyday activity. Doesn't matter whether it's driverless cars, robots, drones, your algorithms that we see on a daily basis. But we know yield rates haven't settled down yet because we know the Fed is going to be raising to 75 basis points, and we know the other central banks are going to keep raising also. But what helped us out a lot is that weaker dollar. If the dollar can get a little more weaker, this will stabilize tech, and then of course, that includes crypto. And we had the VIX down today, and we know if yields are down, the dollar down, VIX is down, that means the stock market is going to be up. But I definitely see the VIX start to get volatile and move up because we have GDP numbers this week. Next week, we have the Fed rate hike. And then the week after that, we're going to have midterms. And I definitely see the Republicans coming out victorious. And we know what's about to happen after that. But guys, that's all I have for you. Have a wonderful day.
um, almost exclusively a function of the Fed and expectations that they're going to slow the pace of rate hikes. For sure, I think earnings season is progressing well, and I've been in the camp all along that when we have inflationary recessions where real GDP growth contracts, but nominal continues to expand like 1970, 73, 75, 80, or 81, 82, earnings downside is much smaller than it would be in a credit type crunch like the Great Recession or even 90 when the commercial real estate market collapsed. But this is really about the Fed, and it began with instability that began after the last FOMC meeting. The Bank of Japan intervened to the tune of $21 billion the subsequent morning. We've seen extreme weakness in Europe. And listen, this is something I think you could appreciate in particular, Brian, with all your great work on energy. The dollar has become a petrocurrency. For almost 5 decades, when energy prices were strong and there were shortages in energy prices, the dollar went down. That happened in the 70s and in the O's, whereas in the other decades when energy was more abundant, the dollar was strong. That's no longer the case. So we're actually making the situation much worse in Europe, much worse in Japan, the situation being the energy crisis, by tightening as aggressively as we are. And I think Lael Brainerd was the first one to pick up on this. She's the start of the dovish, developing dissenters. Well, and it's now translated out to Daley and Evans, George for other reasons, but there's a constituency that wants to slow the pace.
Well, listen, there was a great note out by Data Trek Research. By the way, I made it my RBI on WEX tomorrow morning, which is this is one of the most volatile periods in the last 20 years for the stock market in terms of more than 1% moves over a given number of days, right? We had a great early spring rally. Then summer was absolutely terrible. Now we're rallying again. It's been highly volatile. And what their point was there, Nick Colas and them doing some great work, was that will not stop until the Fed stops. Sounds like you would agree with that until and I'm so sick of talking about the Fed, Barry, every day, right? But we have to.
Yeah, when you look at the correlation across asset classes, walk in and every morning and look at what the dollar's doing. If it's up, so are bond yields, stocks are down, commodities are down. That correlation is so intense, and it's all because of the Fed, and it's how the Fed impacts monetary policy around the rest of the world. So, this hasn't been about inflation for a number of months. We saw inflation break-evens, expectations of inflation collapse in September. It's been about the Fed's reaction function to inflation. So the markets have been screaming, particularly the belly of Treasury curves globally, that it's time for the Fed to start taking a look around and easing, slowing the process and easing back.